presentation contains current opinions of Moez Ansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compact Market Wrap YouTube update for June the 30th, 2025. I'm Mo Ansari, President of Compact Asset Management, and thank you for joining me today. First of all, don't forget to click on the subscribe button so whenever I post an update, you will be notified and you can watch it at your convenience. Looking at the markets, I always love saying this: new all-time highs for the market or the S&P on a closing basis. And the market continues to move higher. As I said last week, I think the focus shifted from Iran and the war to the big, beautiful tax bill. And what the market is telling us, and there's a lot of rhetoric, oh my God, the deficit is going up and this is going to be cut and that's going to be cut. The end result, as far as the market is concerned and the financials are concerned, the market likes it. That's the bottom line. That's why the market headed to new all-time highs. It's expected to be stimulative in the short term, and then we'll see in the long term how it works out. But the next 2 or 3 years, as far as the deficit and as far as the economy is concerned, the market is viewing it as a positive. That's the bottom line. There might be things that we don't like, things that we do like in this bill, but it is what it is, and it is probably going to be passed by July 4th. That's the deadline that the president set for this bill. So we will see exactly what comes out of it. But in the short term, the deficits do go higher, and I'll point those out. The market gained 3.45% last week. A quarter, we're up 10%. For the year, the S&P is up about 5.5% for the year so far. So it's come back up. We were down, as you know, in April quite a bit, and then we have come all the way back. Week for the NASDAQ was really good, up 4.25%. For the year, it is up 5.34%. And the same thing for the Dow, up 3.83% for the week. And for the year, it is up about 3.89%, not counting today, which is adding another about 0.25% so far, the way I'm looking at the market right now. Consumer services was the big winner last week. Those are basically Google, Meta, Microsoft, and companies like those that are in the consumer services sector. Energy was the worst, obviously, as prices for crude oil dropped, as the tensions in the Middle East came down, and that is positive overall for the economy. Looking at oil prices compared to where they were at the beginning of the year, we are quite a bit lower from the 72 to about 65. Today we're trading about 64 and change. Same thing happened to interest rates. They dropped from 4.38% for the 10-year down to 4.29%. Big drop in rates. There's this expectation as the economy is continuing to slow, and we do get a lot of data today, and I'll talk about that in a minute, but it is showing signs of slowing. Employment is slowing down. The number of jobs being created is slowing down. So we'll have to wait and see if the Fed decides to cut rates or not in July. It's about 50-50 right now that they will cut rates in July, from being restrictive to going to a neutral stance. That's right now the policy is rates are at a point where it is slowing the economy, even though it is tapping slightly on the brakes. It's not stepping hard on the brakes, but it is slowing the economy. Will they take the foot off the brake and let the market go at its own momentum and the economy go at its own momentum? We'll have to wait and see. The big deficit talk is that it is going to go up, the deficit. We are right about here now, about 6.4%. It is expected to go about 7% of GDP if the bill passes as written. Baseline, this is the way it's written. It goes up from here to here, and then it goes up in 28 a little bit more. But then we are not looking at this huge revenue that is coming in with tariffs. The tariff revenue starts to bring the deficit down, as you can see, in 2029, and then it brings it down even more to about where we are or lower. That is baseline tariffs, and I think we'll still negotiate a lot of the tariffs. As we saw on Friday, the president announced we're not going to negotiate with Canada unless they take away that digital tax that they had put on. Retroactive, by the way, that tax was going to 2022, and it was about $1 billion that our companies were being taxed. The president said this is not fair. We're not going to negotiate. If you put the Canada came around yesterday and said, that we're repealing that tax, it's not going to take effect. And I think it is just basically trying to level the trading, the field as far as the trading revenue and the trade is concerned with the rest of the world. They had a free lunch. They could export anything to the United States, no tariffs. We export anything to a lot of these countries. They had tariffs on our exports. So what we're doing is trying to rebalance. It will not all get rebalanced, especially with China, because we import so much from China. But it is, the president is trying to bring this back in balance. That's what it is. For 75 years, and we had a lot of access here in the United States. Our economy is much larger. It was much better. Their economies are devastated after the Second World War, but that was 75 years ago. We've come a long way since then. Their economy has changed. The world has changed. So trade policies have to come back in line. And I think that's what the president is doing. I don't think he gets, he's starting with some very high numbers. That's a negotiating. He drops it back and we negotiate somewhere closer. I still don't think it's all fair, but it's as close as we can get. And I think the president will continue to put the pressure on countries that are just trying to take advantage of the United States. Looking at we did see the PMI fall to 52.8 last month. Consumer confidence also is down. Inflation PCE is down to 2.3%, which is slightly higher than the 2% that the Fed's target. This is the number. PCE is what the Fed looks at, not the CPI or the PPI. So it is getting closer. So inflation is coming down, economy is slowing. That could give the Fed the cover to start bringing rates down. Next week, I think the big number is going to be the non-farm payroll. It is expected to be about 110,000 jobs. For last month, it was 139,000. So still coming down. The economy is slowing. We are creating about 250,000 jobs on average, I believe, for the last couple of years, and now we're down to about 100,000 jobs being created. Still sort of slowing down. The unemployment rate is expected to remain steady, but if these numbers come in worse than expected, I think there'll be a lot of talk about rates coming down in July, the Fed to start lowering rates to sort of take the foot off the brake on the economy. Looking at the technicals, we continue to move higher. Target is somewhere around for the projection for the Fibonacci, comes in right here for the S&P, which is around 6350 to 6450, right around here. We're about 6184 today, up slightly, but we are at new all-time highs in the market. I know there's a lot of rhetoric, there's a lot of talk, this is wrong, that's wrong, and all of that. But the reality is we're at a new all-time high in the market. And that's why I keep on telling so many of you, don't get swayed by all of the news, by all of the rhetoric on both sides, whatever side you're on, doesn't matter. Try to separate that. I know all of us have our own biases, our own political views, whatever that may be. But we have to look at reality and separate politics from economics. I've said that for 30 years and I continue to say that. It's easy to say, but very hard to do. So the market looks like we do have some support around 6,000, which is the 20-day moving average. And now we are about to get what is called the golden cross, where the 50-day moving average, which is this blue line, crosses above the 200-day moving average, which is this, which is right about 58.27. Is the 50-day moving average, and 58.33 is the 200-day moving average. So very close to getting this. When this goes below, the blue line goes below, that is called the death cross, and this is called the golden cross. It's a lagging indicator, but it gives you an idea of the trend in the market. Weekly charts, again, still pointing to somewhere around 6350 to 6400. That's 6450, somewhere around there, a little bit maybe higher. I'll look at the exact numbers, but that's the target. That's the Fibonacci target from this high, and we're getting closer to it. We're about plus or minus 6200 to today for the S&P. So it looks like this was wave 3, this is wave 4, and we're headed to wave 5. Once we get to wave 5, that's when we get a correction here. We saw wave 5 right here in 2022. We came all the way down from there to here in 2022. That was the big market when it dropped from 4,800 down to about 3,800 or change, and then 3,700 and change, and went all the way up. So it dropped about somewhere around 20%, close to that, on this after we see a fifth wave top. But first we got to get to this fifth wave top here before, and if we get break above it, then we have to set new targets. Doesn't mean it has to stop there, but that's a weekly target. So we could get there and go sideways. I think still we have a couple of months to get there from looking at the weekly charts. NASDAQ, same thing, third wave high. We could get a fourth wave pullback, support around 19.6. We're 20,300 on the NASDAQ. Again, new all-time highs for the market. Looking at the weekly chart, still pointing to somewhere around 21,000 to 21.5, somewhere plus or minus right around here. We're looking at as the fifth wave target. That is the projection from here. So we'll have to wait and see once we get there. 10-year note, interest rates down big, broke below the 200-day moving average right here, which is 4.31. Today we are at 4.24. So again, slow. The bond market is telling us the economy is slowing, but this is just back and forth in this range that we have in the rates, 4.10 to just going back and forth, back and forth. We did break here, came down here. If we break below this number dramatically, that will show me that the economy is really slowing down too much. So we don't want the rates to go down too much because it'll tell us the economy is slowing. We don't want the rates to go up too much. That means we've got too much inflation. So as long as we're in this range, we've got the Goldilocks as far as the rates are concerned. Maybe a little bit lower might be good. Never helps. So we'll see if that is the next stimulus for the market. Gold market, after the decrease in tensions, coming back down a little bit. But again, the fifth wave target is somewhere around here, which is around 3,600 from this high. Fourth waves are messy. We might go up and down a little bit. But still, I think it's a buying opportunity if you can get somewhere around 3,150 for the gold market. But again, I think there's other ways better than gold as far as I'm concerned. Oil prices saw this spike because of the tensions in the Middle East, but now we're back down to here. Again, we were down to 57 and change at the beginning of May. So support is 63.74. We're trading around $65 today in the oil market, but it has come down, way down from the spike we had seen with the heightened tensions in the Middle East. Overall, markets look good. We'll have to see how the unemployment data comes out. As I've said, again, in April, all the hoopla, oh my God, we're going into a recession, all of that stuff. It was a buying opportunity now that we look back at it. Again, don't let emotions take over. Make sure you have a solid plan. If you don't have one, give us a call. We'll be more than happy to sit down with you, develop a plan for you to get you where you want to go financially with the right risk in your portfolio, looking at what your objectives are, what your goals are, what are you trying to gain financially. Making more money for the sake of more money is not the answer. So make sure you subscribe to this channel, or you can just send us an email at invest@compact.com or give us a call. The initial consultation is free. There's no cost. We'll sit down with you. We'll develop a plan for you. It is free. There's no reason why you should not get a second opinion on your financial future. Again, thank you for joining me today. I will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compac Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compac Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.